So thanks again, Bradley Duke and Vladimir Suporov, because I leave the floor to Adam Back for his speech on the future of finance and Bitcoin. Thanks again, gentlemen. We can leave the floor.
Okay, thank you. So I'm going to talk about tokenization now, different topic. So my company Blockstream, which is kind of Bitcoin infrastructure technology company, we build Bitcoin layer 2, hardware wallets, software wallets, and one of those layers 2s is for tokenization, smart contracts, share settlement. It has about 5 billion of different types of tokenized assets on that, between public company shares, corporate bonds, small company debt, and other kinds of interesting native things like Bitcoin hash rate contracts. So sort of securitized versions of the Bitcoin mining output, let's say. And Blockstream has been around for about a decade. So it started in 2014. So we've been around for a long time in Bitcoin terms. And we have always focused on a security-first approach. So with smart contracting, historically, there have been a number of security issues and sort of smart contract exploits that have resulted in, $1 billion or 2 of a lot of thefts ultimately per year, which is, obviously not good and not useful for serious large-scale financial use. So at Blockstream, we focused a bit more on robustness, security, and less on sort of advanced features, because I think ultimately most financial instruments are governed by around 12 different types of contracts, corporate bond, option contract, and so forth. That covers the lion's share of actual invested capital. So having robust and reliable contracts doesn't need necessarily a lot of complicated functionality, but just dependable, reliable implementation of common financial instrument logic. So then we'll talk about the sort of types of tokenization. So in many ecosystems, you have quite complicated behavior. So information about the contract, state, information about the user's sort of business logic almost implemented in the network as a kind of programming substrate. And so I think that ends up creating the complexity. So with Liquid, which is this kind of Bitcoin layer 2, all of that logic is handled by more conventional technology. So, there's a share registration agent, there's a database that has individual investors, and when there's a transfer that happens there, any kind of administrative function is handled in conventional IT systems. But nevertheless, you get the tokenization experience on the network, but with lower risk. And actually, it's a lot simpler effectively, which is the point. And so with that, you get much more dependability. Excuse me one second. So you get more dependability, more high assurance, and so I think tokenization, you've heard from other speakers today, is considered to have a future. It potentially lowers the cost of securitization, opens the market up for a long tail of markets, of assets with markets. So for example, one application that is quite interesting is securitizing, or at least tokenizing, hedge fund units and doing the accounting in a way that's conducive so that the units from different investors that came in at different watermarks are interchangeable financially, perhaps by mark to market, standardizing so that the units have the same economic value. And then having a secondary market so that people don't have to plan around redemption rights, or can get secondary market liquidity, maybe with some slippage and so on, but nevertheless that liquidity is interesting and perhaps enables more people to, enables more liquidity because people have that secondary assurance that they can potentially achieve liquidity in a secondary market where otherwise they would, perhaps make a smaller allocation if they didn't have that assurance. So the concept and the title for the talk about Bitcoin being the future of finance being on Bitcoin is that with Bitcoin you have a lot more secure and simple ways to do this tokenization. And the Bitcoin network has the best security record of the many thousands of coins on the market with different smart contracting capabilities. Because it's always focused on the security first and it's been around longer. And so sort of, perhaps counterintuitively, the simplest, oldest technology is the best because you need to rely on it, and using new experimental things is actually what creates risk. With Liquid, you have faster settlement. So for people who are familiar with Bitcoin as a technology, the transactions can be a little slow. It could take, an hour or something. I mean, not slow compared to a wire transfer, but slow compared to a trading venue or a exchange, a brokerage, that kind of thing. And so with Liquid, you have 1 minute settlement. So it's not high frequency, but it's much faster and sort of deterministic, dependable time frame than Bitcoin transaction settlement on native underlying. I think another interesting area for tokenization and a new-ish development in the Bitcoin exchange ecosystem is the addition of more qualified custodians and the regulatory improvements in the US that allow the big custodian banks to enter that line of business. So Blockstream Capital Partners made an investment in Komainu, one of the institutional custodians in the Bitcoin space that holds UK government Bitcoin. And the idea there is that, of course, traditional finance is organized with independent custodians for the shares and assets of the investors, individual and institutional, from the exchange venue itself. Historically, that hasn't been the case in the crypto trading environments. There's been kind of single entities commingling risk between the trading risk, the leverage, management of leverage and margin risk, and actually custody of the underlying assets. And so ultimately, in the wake of some market losses with the FTX issue, and there's been some history of similar things going back a decade, that has been an impetus for more institutional and even retail traders to demand independent custody for their digital assets. Now, that also helps in terms of tokenization, because with tokenization, as an investor, as well as the instrument, you get a token to manage, and most investment management systems don't have a capability to handle the tokens, so the introduction of independent custodians with institutional reporting allows them to have that entity hold the digital asset, the digital tokens representing the underlying, and have that reported in a normal way. So I think that is a sort of positive technical move in the space, and also significantly reduces risk for trading on crypto assets. The exchange platform risk is a potentially material risk historically. Many years ago, the original kind of sort of famous or infamous risk was the Mt. Gox Japanese exchange, which was a bit of a market shock. So it's good to see some structural changes in the way that digital assets are managed on the exchange platforms. Plus, of course, there are now more institutional players coming into the space with CME, Fidelity Digital Assets, and other new Wall Street entrants, new venues where you'll be able to trade on platforms with much deeper liquidity. So I'm going to compare the Bitcoin assumptions from the layer 2's liquid. So at the bottom you have Bitcoin, which is the kind of physical layer, the bearer asset. That is, the use cases on that are ultimately a big part of the value proposition. So, whether that's users getting some form of asset protection from bearer holding Bitcoin, or, sovereigns and public companies feeling they have custody via a custodian, or natively for some sovereigns. That's the kind of physical layer. And then there's a Lightning, which is more retail payments and emerging market remittance payments. Simplicity is a simple smart contracting system built on top of Bitcoin that provides much stronger security assurances than the kind of EVM-based smart contracting. And Liquid is the layer 2 that's focused on, Bitcoin layer 2 that's focused on tokenization, settlement, and smart contracts using Simplicity. So people generally think about Bitcoin as just the native network for Bitcoin, and they assume it's not programmable, and that it's hard to scale, which is, blockchains are a broadcast system, so it's hard to create a large volume of transactions on them efficiently. But in practice, you get back many of those features using layered network approaches. So for the high scalability, for retail payments, you have Lightning. For other asset types, stablecoins, tokenized assets, you have Liquid, a different layer 2 for Bitcoin. And so in practice, you do get the functionality just in a layered, structured approach, which I think is a good approach because you get the security guarantees from the simple underlying network and use of Bitcoin based technology. Now, with Liquid, there are a number of different assets on it. So I'll give some examples of the different assets on the network. So there are corporate bonds. So one of the biggest by market value use cases on Liquid is promissory notes for the Mexican small business customer. The liquidity is provided ultimately by 2 large US banks, and it's around $2 billion of business loans. The typical loan size is like $25,000, $100,000. So there are small business loans, but there are many of them. And this use case is growing at about 100 million a month of placed capital. It'll be running for a few years. And what that is achieving actually in terms of unlocking a new use case, because I think it's important to distinguish between a success story for tokenization where the technology has enabled or been instrumental in growing and developing a new market versus tokenize an existing asset where there's no new trade or liquidity or secondary market formed. And so in this case, the point is the promissory note system in Mexico was previously paper-based and unreliable. So there were mistakes in the processing, inefficiencies. And so what the companies did is they worked with a local system integrator to build a system that involves DocuSign and a corporate bond for the promissory note that is tokenized and tied to the DocuSign. So it's really a kind of digitalization effect, and the result is much more efficient and conducive to business, and so it's been able to grow. There's clearly demand for these kind of sized business loans in Mexico and actually in some other LATAM countries. I think there will be similar demand. And so that has, grown very quickly. Another kind of corporate bond scenario in Liquid is there are companies that are securitizing and tokenizing Bitcoin hash rate. So this is the mining activity in the Bitcoin network. So you're familiar maybe with some of the public mining companies like Marathon, Hut 8, and so on. And they build infrastructure, they buy Bitcoin mining equipment, they put it online, they mine Bitcoin. And so what these companies have done is to tokenize the hash rate and the Bitcoin that's mined as units that have 1 petahash per unit. And so, the amount of Bitcoin it mines varies over time based on the Bitcoin mining fundamentals. But that became then a tokenized collateral for finance. So this is kind of mezzanine financing for Bitcoin infrastructure. So they use the tokenized hash rate from their company as the collateral to borrow capital to expand their infrastructure. And there's about, I think, $500 million of infrastructure loans supported by this kind of hash rate. And there are markets for the hash rate, so secondary markets, OTC, and exchange listed on Bitfinex, which is one of the international exchanges with a securities license. So I think that's the other interesting phenomena recently is the crossover where Bitcoin and crypto exchanges are obtaining securities licenses so they can list securities. And of course, it shouldn't be a surprise that the market-listed securities that are most interesting to Bitcoin investors, whether that's hedge funds or individuals, are things that relate to Bitcoin. So Bitcoin miners, Bitcoin treasury companies, and peripheral companies like NVIDIA, Tesla that own Bitcoin or are related to kind of high performance computing, AI workloads, that kind of thing. And so there are some equities that have been tokenized on Liquid, public equities, the first being MicroStrategy, which has been traded in this tokenized form for about 2 years now. And it's actually, and then you would ask, well, why do I need to trade a stock in a tokenized form? What does that achieve? And the answer is that the stock markets are only open about 20% of the time on a weekly basis or annual basis due to out of hours trading limits, bank holidays, weekends, this kind of thing. And so, whereas the Bitcoin markets are open 24/7, as was discussed in the panel, that means that they have kind of global coverage, global accessibility, immediate liquidity for geopolitical events or so it's a market that's accustomed to 24/7 trading. And so for that market, it's attractive to them to have 24/7 trading on what they would view as Bitcoin derivatives, like Bitcoin miners, public mining companies, Bitcoin treasury companies is a different kind of Bitcoin derivative. And so with these markets, they're able to get 24/7 trading on MicroStrategy for a couple of years now, on Metaplanet for about a year, and there's some more in the pipeline. Another development there is the pricing pair. So you can trade them against a US dollar stablecoin like Tether, but you can also trade them priced in Bitcoin, which is an interesting form of pricing because some of the traders are using it as a swing trade where they will, sell Bitcoin and buy MicroStrategy when they view the NAV as cheap relative to the market cap, and then they'll sell the MicroStrategy and buy back more Bitcoin at a higher price as the NAV swings higher. And it's generally, of course, these things vary, but it's generally been the case that the treasury companies hold a positive beta compared to Bitcoin. So it's another kind of volatility trade, a relative value trade, if you like, because there is a fundamental in the treasury companies of the underlying Bitcoin they hold. And so you can see a success story there in the sense that there are some hundreds of millions in these kind of assets, and the volume, sort of the highest day volume on a weekend on this market reached parity about with the Frankfurt ADR on MicroStrategy. So you can see that you can get an interesting amount of trading volume, and there are moves to get more listings on more crypto exchanges, including crypto exchanges with perpetual futures and margin for trading. And so I think that's another differentiator for crypto exchanges, for better or worse, which is very high leverage for the offshore exchanges. So they will have margin limits up to 10 times. I think initial margin 10%, maintenance margin 5%, and on the perpetual futures, some crazy numbers, like 100%, 1% initial margin, 0.5% maintenance margin. So of course the average is a lot lower, but it does mean that people can get more liquidity and ultimately may move the price formation for these kinds of Bitcoin-linked public market stocks into the 24/7 market. Of course, you see the traditional markets starting to react to the 24/7 competition and talk about extending hours, particularly around Bitcoin options, Bitcoin futures, first to 5/24 and then potentially 7/24. So I do think it's an interesting development that equities are coming to Bitcoin exchanges, as well as Bitcoin, coming to traditional markets via ETFs, via the treasury companies themselves, and actually the sovereigns buying both Bitcoin ETFs and Bitcoin treasury companies. I think the Swiss National Bank has about 1% of their stock allocation is in MicroStrategy specifically. And some of the big allocators have large stakes. I think Capital Group may be the largest investor in MicroStrategy, and also in Metaplanet, a Japanese Bitcoin treasury company. So I think this is all, interesting convergence of markets between the Bitcoin trading world and traditional trading world, and providing new types of assets. I do think the treasury companies are interesting because they are a more data-driven, fundamental-driven trade. You have, a public market company with Big Four audited accounts in many cases, and audits and so on. So, and the underlying metric that the ratio between the Bitcoin, their debt ratios, these kind of things, where historically, and we've heard a bit about the large number of altcoins which introduce even more volatility and uncertainty, and I think there are far less in the way of fundamentals there. Because Bitcoin has, a pool of longer-term investors, and so a treasury company has the underlying Bitcoin, whereas trading Bitcoin versus altcoins or strategies around that are much more speculative in nature, and it does seem that the sort of increase in allocation towards Bitcoin versus altcoins has just generally increased from institutional interest, because I think the institutional investors are already seeing Bitcoin as volatile, so they would be less inclined to place capital into more speculative digital assets. So this is just what I was saying about Bitcoin Layer 2 smart contracting, which enables some of the things we've talked about: higher assurance for digital assets, higher assurance for smart contracting, whether that's covered call options or corporate bonds. And I think one of the big differentiators here is you have some formal verification possibility, which is generally absent from all of the other smart contracting platforms, and is an important consideration for high value use. I think absent those assurances, you generally see financial institutions operating on private networks, actually, you know, not on the internet, not on open networks, because of the security risks. So that is the end of my talk. So thank you very much.
Thank you. Adam Black, thank you very much. Thank you for sharing your vision. Well, Adam, let me just ask you a quick one, because I know that you're about to launch a treasury company, digital asset treasury company, that will be listed. When will this happen?
So it's we did the raise last year, but we're waiting regulator approval, which looks to be roughly in April, we would expect.
All right, pretty close.
Yes, and you know, the amount of Bitcoin that company will have depends on the Bitcoin price. So actually, for once, we are happy that the Bitcoin price is a bit lower because we raised about 1.5 billion in different types of equity pipes and convertible notes and so forth, and 30,000 Bitcoin in Bitcoin. So if the price stays around this level, we can get to perhaps number 3 on the league table, whereas over 100,000 we might be looking at more 4 or 5. So it really depends on the market and what happens between now and then.
So currently buying time for Bitcoin. Thank you.
Thank you.
All right, thank you, Adam.